Thanks for tuning into Talking Point. I'm your host, Neeraj Shah. Our guest today is Jeetu Panjabi. He joins us after 18 months, and which was the first time that he spoke to us then, back in October 2020, if I'm not wrong, wherein he made this call that we are in the midst of, or we were in the midst of, or we were starting off on a super cycle. And boy, it played out really well. He's made another call on which we will base this entire interview on over the course of the next 20 to 45 minutes, as the case may be. Jeetu, great having you. Thank you so much for taking the time out and speaking to us.
Thank you for having me on the show. Appreciate it.
The pleasure is ours. So, Jeetu, let's try just a brief, Jeetu. I'm sure the people who matter and who are in the circles know you. If you can just quickly tell us, what do you do after the very sparkling career that you had on the professional side? What do you do currently? And tell us a bit about that amazing call that you had given, and how do you think it's playing out now?
Okay, so first, 1 minute introduction. I spent 20 years at the Capital Group. I right now invest principally, as well as help some international investors on their investments globally. So it's more macro and cycle analytics research that we do, which is the core engine of what we do. But we're basically looking at markets all over the world and looking at how we should be investing and what we should be doing.
Great. Now, Jeetu, tell us about that call, because it was, in a manner of speaking, counter consensus. Nobody used the term super cycle back then. You used that. It turned out really well. How do you feel about it going forward?
We have to be grateful and accept with all humility, kind of say that, we were very fortunate to be right. It played out well. I remember it was quite ironic that we had a few people, when I informally chatted about this with a few people in June and July and August of 2020, they said, "You're mad, you're crazy. I fired 5,000 people and you're saying we're going to have a super cycle in a year." I mean, but I just on a more rational front, I think the reason the reason our analytics was able to spot this was our analytics is different. We do linear and non-linear analytics, both on the macro side as well as the cycle analytics side. I think that's a unique skill set that we have in our analytics, and we use that. That worked out and helped us spot this coming super cycles. But again, I would say, in all humility, we're grateful to God for having got it right, and we were fortunate to get it right.
So has it played out, or is it still in the midst of playing out? Because when I read your new note, which says that the world in disequilibrium, seems to suggest that the super cycle might have played out. Also, coupled with this is my follow-up question, which is, if you can just tell us in a nutshell, what is this new note about? And then we'll dive deeper into the nuts and bolts.
Absolutely. Okay, so one super cycle is over. Okay, it played out over 18 months. The way we calibrated it was you had double-digit dollar GDP growth for the world. The world went from a $68 trillion world to a $100 trillion world this year. We thought it would touch a $100 trillion world in the first quarter of 2023. Guess what? We're already there. So the super cycle played out pretty much to our expectations, but the point is it's over. Okay, the super cycle's over. We're now in a world which is totally different. We're in a world of disequilibrium, and the title of the note is "The World in Disequilibrium." Now, to your point, I'm just going to make a few key messages that I'd love to give the audience out here. Or what are the key messages of this new note? One is that the super cycle is over. Two, we're in disequilibrium, and that's partly driven by this Russia-Ukraine crisis that got catalyzed for various different reasons. And but this conflict was just the starting of what could be a very, very different world 5 years from now. And that's what catalyzed us to write this note. The third key point I would kind of say is, this basically creates a big structural shift in the world and the creation of a new world order. And the new world order essentially has at the peg of it an Eastern bloc that coalesces together. It's going to take 2 or 3, 4, 5 years for this bloc to coalesce together. But the bloc, in our estimate, would include obviously China and Russia's core part of it. We think India is going to be nudged into this bloc on the margin. It's going to stay as neutral as it can, but ultimately it's going to try and get pushed into this block. And we think Japan's going to get pulled into this block too. Now, the point is that the biggest imbalance in the world today is the US external balance sheet, which is the international investment position of US. It's a $16 trillion deficit with a $10 trillion deficit on the debt side, which has tripled in the last 6-7 years. So we think that gets pulled, the rug gets pulled over there under the US's feet, and that happens in the next 3-4 years. The dollar goes into a structural fall. So 40 years of dollar strength basically reverses back into dollar, goes into dollar weakness. It's a brand new trend for the world, difficult to spot right away. And US obviously needs to retaliates at what it's best at, probably a World War III coming up in the next 5-6 years. And it's going to be a very, very challenging time to invest. How do you invest? I think the big question you ask and not the answer you give is, where do we find continuity in a discontinuous world? And that will give you a lot of answers of how to invest. So that's really the core essence of our note of saying, look, we're going to be in this equilibrium and we need to think differently of how to invest.
You're right, Jeetu. It may take people time to try and digest this. It's taking me time to digest your answer as well. And I would love to play the devil's advocate and try and post some questions on your hypothesis, maybe some of your assumptions as well. Would love to base this conversation on that if you're okay with it.
Absolutely.
Okay, great. So let's start off with the first one, right? So yeah, I have your note with me as well. So yeah, the first one, you know, your super cycle thesis, which you believed would play out until 2023, also played out in like 18 months, right? So it's a period, or it's a world we are living in wherein there are short cycles, very short cycles. They play out, in fact, at times quicker than what most people anticipate. And here we have you making a prediction about the rest of the decade. 5 years out, something happens to the US and the US dollar. There could be a third world war, as the case may be. There could be a formation of a bloc, which also won't happen in 12, 18, 24 months. What compels you to make these far out hypothesis in a world which is full of short cycles?
I think, great question, I would say, to begin with. But the point is, we think the old world order is changing. There are dramatic new trends at work. There's, the 40-year trend of interest rates going down is paused, is changed. There are new geopolitics at work. We think a lot of 40-year trends have hit a tipping point, okay? And when you're hitting a tipping point, there is no reversion to mean, because the mean you reverted to is no longer going to be stand good in analytical models. So you need to think of crystal ball gaze. What's the next 5 years going to look like? What is the new mean going to look like? What do you peg your analytics around? And how do you think about investing from here? Now, in my view, a lot of us are going to get caught on the wrong foot, and me, myself included, that we're going to get caught on the wrong foot. And unless we crystal ball gaze and run our analytics through what the next 5-7 years looks like, you're going to be having a really hard time investing. Yes, you can revert to the mean, but often that mean disappears because it's no longer relevant. So that's the reason we're looking at a 5-7 year period and then thinking through what's going to happen. We think the world's going to be totally different.
Okay, fair call. So I understand the rationale for which you're doing this. Now let me try and talk about some of the points that you made. The first one, you say that the super cycle is over. That's the primary thing that we started off with. My question to you is this an end of a super cycle that you also predicted, incidentally, or is this a pause? Because when I talk to corporations, they are all sounding fairly confident of initiating Capex and the Capex paying dividends at some point of time over the course of the next 12 months. I agree. My view may be biased because I talk to a lot of Indian corporations and not as much MNCs. But when I read about brokerage notes that have come in about MNC corporations as well, there's no dearth of confidence of investing in a lot of places thus far. So why do you presume that the super cycle is over? Could it be a pause and not an end to what you call as a super cycle?
So again, I think it's a very, very valid question. So first run, let's run the analytics. What drives Capex cycles? It's profit cycles that drive Capex cycles, high utilization that drives Capex cycles. It's higher staffing utilization that drives, it's higher capital utilization that drives Capex cycles. So the point is, we've just been through a super cycle. Everybody's capacity utilization is high. They feel the need that, oh my God, we're running at 80% utilization. We're going to be short of capacity. We need to do it. And we've had a major profit cycle that can fund it. And they're going to run a Capex cycle. So no disagreement. That's the classic cycle we've seen over the last 30, 40 years. This is the classic point in the cycle where you come in and do your Capex, and that's expected to happen. The point I'm trying to make is that, one, we're not going to be having a 10, 11% dollar GDP growth for the next 3-4 years. We're going to be having a slightly lower one. But two, if the world's running out of capacity, you need to put more capacity to work. But concurrent to that point, a lot of companies we meet are putting capacity into disruption. So they're putting capacity for hydrogen, they're putting capacity for batteries, they're putting capacity for a lot of stuff that historically didn't have capacity. And that is partly driving the Capex cycle, and partly it's the profit cycle. My sense is some of this is going to be, proving to be a tough one 2 or 3 years from now, saying, I think we did too much too soon. Having said that, I think the world's in disequilibrium. So it's going to be about short cycles. It's going to be about very volatile cycles. It's going to be a tough environment to manage. We're not necessarily saying that the world demand is going to collapse. We're just saying the world is in disequilibrium. It's going to be extremely, extremely difficult to manage these cycles and manage the supply side. And as an investor, it's going to be extremely difficult to navigate and think through what's going to happen, partly because of geopolitical realignments.
Okay. Just one more follow-up question, Jeetu, in that. So, I'm just trying to think out loud here that we're talking about a world which is going to be more inward-looking. The global supply chains, as I read in your note as well, may not necessarily remain the same because a lot of companies will want to depend upon themselves, as is the case with India as well, with the whole Atmanirbhar India program. So, could it actually usher in, it could sure be in different sectors, but it could usher in a cycle of major Capex in defense, in clean energy, in mobility, in other facets which may not have been present thus far. So the winners may not be the same, but eventually there could be economic growth. And coupled with that, we're just coming out of 2 years of COVID. The world is opening up. China, which was locked down, presumably will open up at some point of time. All of that should actually usher in more demand and more growth, right?
Neeraj, I fully agree with you. So defense to case in point, right? Both the UK and Germany has come and said we're going to take our defense spending from 0% to 2% of GDP. A lot of other countries are going to feel that that's necessitated at the current point in time because of what's happening globally. So there are, what I'm trying to say is this is not an economic collapse, but it's not 11% GDP growth, nominal dollar GDP growth. It's going to be a far more muted, far more normal world. It's probably a 4-5% global dollar GDP growth. Within that, there'll be new vectors, to your point, there'll be defense, there'll be EVs, there'll be a lot of new things that are being driven. But it's going to be through a disrupted supply chain. And remember, profit cycles need a period of equilibrium for profits to be very visible and secure. And unfortunately, that's not going to be the environment. So profits are going to be insecure in a lot of businesses.
Okay, fair point. Then I would really love you to go a little bit into how do you spot winners. But just before that, I want to ask you about one more assumption that you're making or one more prediction that you're making in your assumption or in your note. And that is about a new world order, which will be marked by an Eastern Bloc and a Western Bloc, so to say. 2 or 3 questions out here, right? A formation of a powerful Eastern Bloc would probably necessitate China and Japan to be in the same bloc, China and India to be in the same bloc, and a West which doesn't try to, as the Bloomberg story said today, wean India away from its traditional allies like Russia. How does a successful Eastern Bloc theory come in a note wherein there are so many challenges around the formation of a bloc like that?
So again, a lot of this is our view. We're pretty sure we're not going to get all of it right. Okay,
Of
there's
course.
an analytical framework to getting there. So one, China is pretty clear; it wants to be the Middle Kingdom. In my personal view, I think Xi Jinping needs to secure his position for life, and that's what his goal is. That's the entire disequilibrium around China and its neighbors is about. In my opinion, somewhere between September this year and March next year, that decision gets cemented. Let's assume Xi Jinping is cemented for life by the CPC between the September meetings and the March meetings. If that's done, I think the India-China battle is going to be much, much easier. Those battle lines are going to be far more, they're going to wane, and India and China are going to warm up to be closer. The Chinese foreign minister came to India, I think 6 or 8 weeks ago. I don't think he was here for a courtesy cup of coffee. There was more than that. And India's in a sweet spot as far as the Western side wanting to work to prevent it going the China way, and China wooing it to get a counterbalance to the US and making sure the Eastern Bloc is cemented. So India's in a great spot. It's in a sweet spot, and both sides are going to work, and India is going to stay neutral as far as possible, is the view. Now, the other question, how can India-China be friends? I've had pushback from a lot of people. I don't believe that. My question is just go back 98 to 2016. If you just read what happened to trade, it exploded. It went up like 50 times. It was all about business. It was all about, okay, how can we work together? There were businessmen from both sides working closer together, and there was fair amount of engagements and there was no hostility in a significant way. Just to kind of the normal bickering would be there, but it never really was a major issue. The question is the last 3-4 years, in my view, is about Xi Jinping cementing his term for life. It's not about a true battle between the two places. And the 18 years before that was point in case that it worked out pretty well. There were really no issues. So can you work together with business at the core of it and kind of find a path in the middle that works? I think so. That's the core of the China thesis. On the Japan thesis, well, in my view, that Japan is a defense base from a US point of view. US is vacating that base, and that was pretty clear in the Abe regime. Japan is trying to get a 2% inflation target, which was articulated well in the Abe regime, to say that we need that reflationary trade to create fiscal space to build a defense budget. I think that that point or that necessity continues. And as that necessity continues and the Eastern Bloc is being formed, India, in my view, is going to engineer a path for Japan's entry to become friends and not have the risk of China coming and attacking it and doing all the bad stuff. So Japan's going to join the bloc too. Now, I know these are both very, very bold statements, and I'm sure we're not going to get all of it right. But having said that, I think this is the axis of the Eastern Bloc, and this is what the new world's going to look like.
Yeah, it is the other reason why, aside of the India-China hostility that exists right now, or probably has existed in the past as well, the other big being that, just in the last 12 to 18 hours, there is talk of US preparing a special package for India defense to wean India away from Russia. There's a large Indian diaspora in the US and a large presence of US corporations in India, all of which would want to see that the ties between US and India in particular, and the West and India in general, because India is such a large market as well, stay very, very strong, and India doesn't drift away from them. That is what is a bit, is a small challenge, I think, to this assumption of an Eastern Bloc wherein India and China are together, aside of their own individual relationships.
So, Neeraj, I would disagree with that. I think that is a clear risk to my view, but it's also going to be in the sweet spot. So both sides are going to woo it, and India can take advantage of that. I think the picture becomes a lot clearer 2 or 3 years from now, once Xi Jinping has cemented its position. US goes into a recession next year. It goes to the peaking of the rate cycle, and the dollar starts falling. And what happens next? I mean, those are the timelines or the milestones that we kind of work with, saying whenever those events play out, we're going to be looking out and saying, how does the picture change at that point, and how do we navigate through it?
Okay, interesting. So yeah, I'm glad, Jeetu, that you are also giving it some time to obviously the theory to play out, and it'll be very interesting to see how it shapes up. But fascinating views. Thanks for that. Now I'm gonna don the hat of somebody who's more interested in trying to understand how do investors capitalize on, if these events were to play out, then how do investors capitalize on that, so to say. So one, if indeed that such a scenario were to play out, what happens to the dollar hegemony? Does it come under challenge? And if so, do the traditional alternatives like gold benefit? Does a Bitcoin benefit if you've thought this through? If some of the other safe havens like the Swiss franc or some others benefit? And how does India kind of fit into the picture of, if indeed the US were not to remain a world superpower, or in its truest sense as the only superpower, so to say, and if indeed the dollar were also to weaken, as you said in your note?
So I think this is going to be a very, very long-term trend once it begins to happen. US is today 25% of world output. US is roughly $25 trillion in output in a $100 trillion world. In our estimate, that goes down over the next 6-7 years to a 16% a share of output. The US in absolute grows, but the world in dollar terms grows faster. We could probably go to $185, $190 trillion world by 2030 in our view, right? What happens to the dollar is that you've got a $10 trillion balance sheet, external balance sheet deficit from a debt perspective alone. The creditors to this balance sheet, as I've had discussions with a bunch of them in recent months, in the recent weeks, clearly are uncomfortable with the weaponization of the dollar reserve that was used in the Russia story. And they kind of say, look, I got a huge amount of dollars. Am I safe in dollars? Is it going to get weaponized? Is it going to get demonetized? And what are the implications of that? Question is there an alternative for the dollar? Absolutely not today. Okay. Are you going to go from the US dollar, 60% of most central bank reserve baskets, 20% euro, and then you got the sterling yen, and then a 3% on the yuan, right? Are we going to move to a more multilateral basket, a basket that has a greater EM presence, emerging market currency presence? Absolutely, which reflects the true trade partnerships that are there in each of these countries. For example, like palm oil from Indonesia and Malaysia, it buys a lot of products from China. It's got other stuff, electronics it buys from Korea. Do I see those currencies reflected in the central bank reserves, the RBI reserves of India? No, I don't. Do I see there's a possible move towards that? I think so, and it's logically the right thing to do. Do you think that $10 trillion deficit in the US external balance sheet is going to get slowly pulled over time, and that has implications on how the dollar starts moving? Absolutely. And what's the timing on that catalyst? Possibly when dollar rates peak, or when you probably have a US recession side, and the US says, I'm going to either print more, or I'm going to ease rates, and then you kind of see that slipping away. But this time, when the dollar starts moving down, in my view, this is a 5-10 year decline, and I don't think there's a way out, because printing's been the natural solution for the US. I think that solution goes away. Do I see a greater position for the yuan and other emerging market currencies in EM baskets? I think so. In central bank baskets, I think so.
Okay. So, with the presumption that this turns out to be true at some point of time over the course of the next 2, 3, 5 years, Jeetu, how does one invest, taking this into account? Let's assume that this is a hypothesis that does turn out, and you firmly believe that it might, or you're giving a very high probability that it might. How are you investing? And are you investing for that thesis from now on, or are there some triggers that you're waiting for which will make you invest keeping this backdrop in mind?
No, absolutely. Look, we've been around markets, and we know that you could be wrong for longer than you're solvent. And you never need to be brave and kind of put up your capital against the market. Dollars, USD is hitting a new peak. The DXY is hitting a new peak. The ADXY is changing gear, but the world's changing. So in my view, you gotta watch for your events to play out. You can let the first 2, 3, 4% pass you by, not be too brave and challenge markets. But when this trend starts playing out, you got to be all over the trend and you got to be riding it. And this is a ride that's going to go a long way. So I think that's going to be one thing for sure. The second question I have is, as you're navigating this, and let's say you're in equities, uh, businesses are essentially always looking for equilibrium and certainty of profits. And equity investors are looking for that equilibrium in businesses and certainty of profits. And in a world of disequilibrium, both for profits and for market valuations, what we're going to have to do is essentially find sources of continuity in a discontinuous world. Now, we could find that in saying we think the next 5 years we're going to make a lot of money on hydrogen, or we're going to make a lot of money on certain defense businesses, or we're going to make a lot of money on certain consumer staples where the consumer is going to need it every morning he gets up, he's going to need to brush his teeth. And is he going to stop brushing his teeth because there's disequilibrium in the world? No. Is that a source of continuity? Yes. Are we secure in our profits? Probably yes. And do we kind of invest in such businesses? Absolutely. So the point I'm making is I'm kind of laying out a framework which says you're going to look for sources of continuity in a discontinuous world to be able to navigate this period. And you're going to have to wait for trends to start turning or moving and then ride on those trends as you navigate this period. It's going to be a very, very tricky period because, I mean, the classic investor in all of us says, revert to mean. If something's fallen 30%, it'll come back. In my view, I'm not sure that's going to play out. And a lot of businesses are going to have a hard time navigating this period.
Yeah, I mean, certainty isn't sexy and it's never cheap. You believe that there'll still be money to be made by betting in continuity, which kind of stroke takes the form of certainty, so to say.
So the concurrent assumption is there's going to be a lot of volatility, and volatility can either be your enemy or your friend, depending on how well you use it. In my view, we've had two big market retraces in the last 8 weeks or 12 weeks. And if you were to kind of say, I know what I want to buy and I know what I want to own, and I'm going to use this volatility to buy, you'd be much better off today using it as a friend. So it's not cheap, but markets will continue to give you opportunities. And in my view, the next 5 years, there are going to be a lot of opportunities.
Interesting. Jeetu, a set of themes based out of India are how to say, west-facing, in that people believe that, so IT sector got a bit derated because what if the US has a hard landing? But the corporations are still spending money in the US, in the Western world, and therefore IT orders come in. A lot of spec chem companies are doing tie-ups with Western global leading companies which set up bases here. They supply there to the West, to the US, they benefit. Textiles, gems and jewelry, what have you. Now, my question is, if indeed the US is to weaken, if indeed there is a new world order, and if indeed, therefore, a lot of economies start looking inwards as opposed to having globalized supply chains, do you believe the set of winners emerge from companies which are catering to the domestic market, and those will find favor? Is there a way to think about this?
Neeraj, it's extremely difficult to crystal ball gaze all of these metrics today, right? But I think some of these metrics or some of these pointers would be very clear 6 or 12 or 18 months from now. And you're going to have to keep looking for these milestones to steer differently. In my view, if a business is purely looking at the US or has 80% of its business in the US, and the US is having a hard time as we kind of think about over time, or at least there is a significant challenge to the US dollar, they're gonna have a hard time. There's no way you can be insulated from that. So my point would be a lot of smarter businesses would have diversified that risk, would have done a few things differently to make that work. And I think that that's the journey businesses are going to have to navigate through. It's not going to be easy. And I kind of articulate very clearly in the note that I do not want to be the CEO of a company which has global supply chains. And it's going to be a nightmare, and it's going to be a lot of sleepless nights for these guys once that trend begins. So, yes, would you think, again, more regional or more local companies might do much better? I think so. But we'd have to wait for we'd have to wait for the pointers to emerge that this trend is clearly starting and building and going to have a period where it accelerates.
Okay. And just a quick follow-up there, and then I have two more questions, Jeetu, and then we'll wrap this up. We've taken a lot of your time, but if indeed India is the cynosure of all eyes, so to say, because we are in a sweet spot, as you mentioned in the interaction, even if economies globally were to look inwards, the China plus one theory, the need for the West to have a strong ally in this eastern side of the world, namely India, does all of that mean that even if there was going to be an inward-looking world, select Indian businesses which are global dominating and have a preference for all these years in the West might still continue to get business, even if, like I said, the world is more inward-looking?
I think we'll have to wait. We'll have to wait at least for some of this picture to settle, right? I clearly can't crystal ball gaze that far to kind of say how challenged these guys are. How are they going to change the model? Are they going to sell off the business to US entities and say, let them drive and so if there's going to be big changes, that's pretty clear. How does the model emerge and how do people navigate? Much tougher to do today.
Okay, which is why I think, Jeetu, you mentioned in your note at the end that milestones, I quote you, that milestones to our roadmap would be critical to watch and navigate, with timelines being less important to the thesis. I think that's probably one reason why you say this.
Absolutely. We're going to have to, just to be more clear on that, I mean, if the minute you have 2 or 3 central banks saying that we're going to change the reserve basket away from the current basket to a new basket, we know that's one milestone we're looking at. The second is that we're going to have high inflation in the US driven by import prices rather than by domestic monetary policy or other factors. That's a second milestone. So there are going to be a lot of milestones that play out. And, like just a case in point, Indian gas is an extremely important source for semiconductor plants, a need for semiconductor plants, and 50% of that comes out of Russia. Is that going to get blockaded, or is there going to be some geopolitics around that? Does that turn into another significant turn of events and you have semiconductor prices go crazy? So there's a lot of milestones that are going to be visible over periods of time. Does it happen in 6 months, 18 months, 24 months, 36 months? I don't know. So as you see these milestones, your investment head gets donned and you rethink, or you kind of then take your next course of action and plan what you thought about and try to either buy risk or stay away from risk or buy certain businesses. A lot of this is milestone driven, not timeline driven, and that's clearly one place where I'd be wrong. I'm not saying the timelines are hard in stone. I think milestones are more clear to me, and I could be wrong on the timelines. I think if it happens in 3 years versus 7 years, I don't know. We just have to accelerate our thinking into kind of navigating and investing through that new horizon.
Could you be wrong not just on the timelines but on the thesis? What could thwart your theory?
I think. Look, it's pretty clear to me that these geopolitical the picture that we're kind of alignments that we're looking at, could we be wrong on some of that? Absolutely. Do I think that the US dollar external balance sheet is something that's going to get triggered along the way? I think so. I think I'll be less wrong on that. I could be wrong on the geopolitical alignments. I could be wrong on the timelines. But I think it's pretty clear that the world is in disequilibrium. It's pretty clear that the new geopolitical alignments at work. I think it's pretty clear that is going to be an extremely difficult period to navigate. And you're going to have to keep looking at milestones and recalibrating your thinking on a real-time basis every 3 or 6 months. And I think, we'd be happy to come back if we think differently 6 or 12 months from now and talk about it again. But clearly, we're staying humble, we're staying agile, and our antennas are up to look at all the risks and all the issues that we have to kind of make sure we get right.
Oh, okay. Jeetu, as an aside, before we wrap up, and thanks for sharing your note and talking a bit about it. But as an aside of what's happening or what could happen to a new world order or newer forces at play, what about the natural occurrence of events that people are talking about, which is what happens to valuations as a result of higher rates, or what happens to the classic growth versus value argument, wherein suddenly value seems to be coming in vogue over growth world over, and presumably in India too. So for the here and now, how do you think about these two factors?
I think in my view, a summary would be that value would be in flavor. Let me upstream that into the analytical framework to get to that conclusion. So the point is, again, it's about equilibrium versus disequilibrium. A lot of the growth businesses in the tech world are going through disequilibrium driven by completely different factors like peak demand and then demand collapsing and disruption playing out over there. So people are again looking for equilibrium. People are looking for certainty. People are looking for stability in profits. And where they find stability in profits, capital is migrating. Right now, it's just a coincidence that the value basket sees greater stability in profits, and that's where the capital's migrating, and that's why you kind of say, oh, we think growth is over and values in play. I think it's less about a style, it's more about just the certainty in profits for a certain basket of companies, and that's where it's going. I would bet 12 or 18 months from now, earlier, how many investors looked at energy as a basket they wanted to invest in? I didn't find anybody wanted to do that. And that's been the best performing sector globally in the last 18 months. And it's pretty clear the profit certainty is much, much higher over there. And especially you've seen that accelerated when the last 3-4 months, you've seen that issue with tech in the US, especially, right? So in my view, it's not about a style. It's about equilibrium and stability of profits.
So is oil the new data?
The answer's in geopolitics, right? Is Saudi and some of the oil-producing countries willing to let oil go back to 60 or 70? I think the answers will be very different. I don't have a clue.
A fair call. Jeetu, this was lovely. Thank you so much for spending the time with us and giving us a sense of your note and your thinking. It's a very different conversation than what I usually do, and I thank you for bringing it to our platform.
Thank you, Neeraj. Thank you for having me, and appreciate it very much.
Thank you so much. Viewers, thanks for tuning into this edition of The Talking Point.